I have helped hundreds, if not thousands by this point, of traders to get funded, reach payouts, and some even go full time. So at this point in my trading and of course teaching journey, it's pretty clear that I know why people lose and I know what it is that makes them win. So today we are going to look at 5 reasons why you're losing at trading and how you can turn your results around fast. These are things that you cannot ignore. If you want to win, you have to fix these very soon. One good trading system can override every bad trading decision that you have ever made. So over these few classes, that is what we're going to be building out for you so you can go forward and win. But we need to start by eliminating the leaks in your system that are costing you everything. So we're going to jump straight into reason number 1, and that is over learning. So in trading, you can actually learn too much. And sometimes the more you learn, the worse you get. It's very likely by this point that you've learned too much information from too many different people. What this does is create conflict in your mind. When you look at the charts, you don't know whether you should follow a strategy you learned from this person or a strategy you learned from this person. Or even worse, you try and mix them together, but because they trade in different ways, it simply doesn't work. So when you look at a chart, if you have information about supply and demand in your mind, you might look at the markets like this. But if you have trend lines in your mind, you might be thinking, well, should I take this trade instead? If you have support and resistance as something you've tried before, you may see the support floor as an opportunity to buy. But then if you understand liquidity, you might think, well, no, that's likely to be taken out. If you've learned fair value gaps, so ICT trading, you might think if the market returns to this zone, I will buy. But if you trade in balances in the way that I trade them, you would be looking for it to be filled instead. See what I mean? The confusion that occurs when you have all of these different systems and way of viewing the market in your mind actually becomes more difficult to find trades because you have learned too much. There are so many different ways to see the market, and realistically, none of them are inherently wrong. I have no doubts that people win with basic support and resistance. I can't do that, and I prefer to trade with logic-based concepts, supply and demand, and things like that. But none of them are inherently wrong because what we're doing is balancing probabilities. The problem becomes when you try and mix these things together because these systems work in isolation. If you have a trendline strategy that has a 50% win rate, that's completely fine. If you have a supply and demand strategy that has a 50% win rate, that is also completely fine. And both of these things are likely profitable on their own. But when you mix them together, you break the edge. Let's say you look at the market from a supply and demand perspective. If you take this trade, it's either going to win or it's going to lose. But if you continue to do this long term, you're going to get positive returns because of your risk to reward. If you trade a trendline strategy, when you take a trade, it's either going to win or it's going to lose. But again, profit is made through probability. Okay? Profits come from the long-term edge that a system has. So let's say you take 50 wins and 50 losses at a 1 to 2 risk to reward ratio, meaning you're risking $100 to make $200. Well then, meaning you're risking $1,000 to make $2,000. Well then you're going to lose $50,000 on the losses and win $100,000 on the wins, which creates a $50,000 net return. But when you mix these conflicting systems together, the edge dissolves because every trade you take is different to the last. So what actually happens when you overlearn is you learn so much that you become worse than when you knew almost nothing at all. Your knowledge increases, and as that goes up, your ability decreases because you've just learned too much and nothing makes sense anymore. So what you need to do to fix point number 1, and don't worry, we're going to get into how we can truly fix all of these things towards the end, is stop learning new things and just turn what you currently know into a system with an edge, or do one final hard reset and focus on turning that into your system and eliminate all of the other chaos that you've been focusing on for so long. So that is reason number 1. Reason number 2 is being outcome focused. This one is super common and also super damaging. So it is likely at this point in your trading journey that you're too concerned about making money now, and you're not thinking about the long-term profitability or the long-term outcomes of your trading. Most traders, when they come to the markets, are focused on making some money today, which means if you come into the markets, you take a trade and you win $100, you feel very good about yourself because you've walked away with a profit. You feel like a successful trader. Now, all you have to do is come back and do that again tomorrow and the day after, right? That is the thought process that people have. But the problem is, this leaves you trading in a way that isn't really best set up for long-term success. So take a look at this example. You could be up after 70 trades where you're just forcing trades each day and you are just looking to make money in the short term. And this feels, in the moment, very successful. It feels profitable because you're making money. However, if you're trading in a way that is too short-term focused and your only interest is making money right now, you're probably not trading a very good rules-based system. You're actually just taking whatever opportunity you think will pay you today. You can make bad decisions. And if we zoom this out and we extend this further, you'll see that this actually can go pretty terribly wrong. because what you're doing is not trading a long-term edge, you're trading short-term returns. You're just looking for any way to grab $100 from the market today. Do that long enough and yeah, you might be profitable for a bit, but everything will come tumbling down and you'll lose your funded accounts, your personal accounts, and everything you put into the markets. So your attention should not be on making money right now. It should be on following a plus EV system. So EV is expected value, okay, or expectancy. A positive expectancy plus EV is basically something that if you do it enough times will produce a winning outcome. Negative expectancy is if you do this enough times, it will produce a losing outcome, okay? So we always want to be trading plus EV. And if you are doing this trade forcing, you are generally trading minus EV or negative expectancy. So there's something in trading that we need to talk about as well, which kind of leads you to believe that you're winning when you're not actually, and that is variance. See, you can do the right thing for quite a while and you can still lose money doing so. If you take perfect trades, you follow your system, that does not mean that every trade you take is going to win. It doesn't mean that you're going to have a winning week or a winning month because the markets decide our results. But you can also do the wrong thing for a while and still win. I mean, you can trade a very bad system, no strategy at all, and just guess your way into trades or gamble your way to a profit today, and it'll win some days and it'll win some weeks, and you might even win for a couple of months. But it's not a winning system long term. So if we take a look at this negative EV trading, so trading with an inverse edge or no edge at all, you see that for a while, a lot of these traders are actually in profit, but eventually everything leads to the downside because the edge just isn't there to mathematically make money long term. This red line trader, for example, was up towards the beginning. They got up even more, actually up to 20% returns, which looks very good, but in the end they still come down below the starting balance of the account because they're trading with no edge and all of the profits come down to luck. So if we look at plus EV trading with just a small edge, you can see again on the variance perspective, some of these traders do go into drawdown. One of them goes as low as 20%. But if we look at the end of this test, all of them end above the start balance because their long-term strategy, the way they're approaching the markets, is positive expectancy plus EV. So it forces the markets to pay them over the long term. Now, if you have a solid, strong edge, this becomes a lot stronger. You have less drawdowns and you have more returns and a more clean run towards where you want to be. Even when we incorporate the variance factor, which essentially says, even if you do everything right, your results may be better or worse than someone else, and there's not really much you can do about that. We don't get to decide our results, but we do get to decide the inputs that create the positive trends that we build, okay? Now this means to stop being outcome focused and instead start focusing on following plus EV systems, sometimes you have to take uncomfortable trades. You have to hold trades past the point of comfort. So when you get into a trade and it's running nicely and you're scared and you want to get out, you have to hold them to your targets because this is what creates positive expectancy. You have to let some wins turn to dust. If they haven't ran far enough to warrant closing and they turn around on you, then that is just the nature of the game. Today's trade losing or today's trade turning back into a break even is not going to affect your long-term performance, but closing every trade early and cutting down the returns that you can make absolutely will. So if you follow a plus EV system and you put yourself through these difficulties of making sure you're holding your trades, letting some trades turn around if that's what the market wants to do, all of this difficulty, these hard decisions will combine to create long-term plus EV or positive expectancy, which is how we make money, okay? You're going to have some stressful downswings, but you'll also have some relaxing upswings. You're going to have some hard trades, but you'll also have some easy trades. And it's all of this combined, following that rigid approach and making those hard decisions when they come up, that actually makes you a profitable trader. When you try to win today every day, you can run good for a bit, but everything will fall apart, okay? So what you need to do to eliminate your outcome focus is focus on doing the right thing. Make those hard decisions when they're there. Don't rush to make money today, every day, because this usually, or pretty much always, ends in ruin in the end. So reason number 3, emotional shortcuts. This is an interesting one, okay? Now, emotions are dangerous on individual trades, as we know, but they're way worse across your broader trading journey. And I know a lot of you watching this are guilty of what I'm about to explain. So on an individual trade, emotions can cause damage, because if you enter a trade and then you panic exit too early because the market's moving in your favor and you're scared that it's going to turn around, you can miss out on massive amounts of profits. And this is really where your edge is, in everything above the point where you early closed your trade out of fear. Another way that emotions can affect trades is, of course, hesitation. You see a setup that's working, completely valid to the way that you trade, but you're kind of scared to take it because you think it might lose. Maybe you're on a losing streak, or maybe you just don't have trust in the setup, even though it looks fine. Now, because you missed that trade and you hesitated away from the entry, you miss out on the whole move. And that whole move could be where your edge lives. If you take a bunch of losing trades, this could have been the win that pushes you back into the green. And if you miss it, well, now you're just going to go deeper into the hole, okay? And the most damaging way that emotions can affect individual trades is, of course, fear when it comes to stop losses, or should we call it hope. You buy into a market, it starts moving against you, but you have such conviction the market's going to go up and you don't want to accept the loss that you take your stop loss off thinking, I'll just let it turn around, it's definitely going to go up. Then it doesn't, keeps going down, and your entire account is destroyed before you know it. So these are the ways that individual trades can be ruined by emotion, and that of course can spiral into big problems. But I would say when it comes to emotions, emotional shortcuts are the most dangerous and damaging thing. So the biggest danger of emotions is when you shortcut important steps in your journey in a desperate pursuit of reaching your goals as fast as possible. Such as, if you are an unprofitable trader and you are already buying funding challenges. I know so many traders do this nowadays because they have this thought that if I just get funded, I'll be able to easily make a few $1,000s. But if you can't trade, no, you'll just lose it all. Same with flipping accounts. You've watched some YouTube videos of people telling you, when they didn't really, that they flipped $100 into millions. And now you're trying to do that as well. But you're not profitable and all you're doing is gambling every day and hiding it under the mask of this interesting trading journey, when realistically you're just a gambling addict. See, when your aspirations are so high that you shortcut important steps of the journey and you try and force those goals out, and your skill sets are just not there to match the aspirations and ambitions you've got, then you lead into this spiral where you just lose money for a very long time. But the most damaging part of this is not the money you lose, it's the time that you lose as well. If you are focused all in on a funding challenge over and over again until you pass it for 6 months or a year, instead of learning how to trade, well, that is valuable time that you're not going to get back, okay? So this is what the real trading journey of a winner generally looks like. You're going to start out flat. You're probably going to go negative for some time because trading takes a while to get your head around. But eventually, when you've worked things out, you will move into profits, into returns, and trading will start to work for you. And trading is usually exponential. So when you get to a point where you have your strategy dialed in, that is when things really start to, fly upwards. But most people don't want to wait through this downward curve. They don't want to give it the time. They don't like the idea that they might not be successful for another 1, 2, or 3 years. And because of that, they want this to happen. They want to try and force a massive, exponential run from day one, which is why people go and flip accounts. It's why people go and buy funding challenges without being profitable. They're just trying to force success as fast as possible so they don't have to wait through this. But here's what actually happens. You usually kick to the upside with, ambition and excitement, thinking you're going to nail this. And then very quickly, things move against you and you just continue to move down. And as we can see across this timeline, alongside losing money, you're actually also losing valuable time. Which means by the time a sensible trader is successful and exponentially getting returns from the markets, you're down here, massively below where you started in terms of money, ability, and confidence in yourself. So you can burn through your life savings doing this very quickly, unfortunately, but that is not even the worst part. The worst part is that you waste the months or years, you build a hatred or a disdain for trading, and you ingrain the worst habits possible that are then hard to break free from. It's harder to win after you've done this. It takes longer to get out of these holes, and it's more mentally draining because trading has beat you down so bad that you're no longer really enjoying the time you're spending trying to learn it. So you can escape this, but you need to do it now. You need to stop chasing achievements above your skill level, master the foundations, and you will naturally climb towards your goals, okay? We'll talk more about how we can do this later, but this is definitely something you need to stop doing right now and start focusing on a steadier journey. So reason number 4 is the desire to be right. Loads of traders chase perfection too much. They overestimate the importance and the viability of being right all the time, okay? So you're trying to get 100% marks in your trading. Most traders will view a good trade as a win. If a trade won, if it made you money, that means it was good. And a loss is by default just a bad trade, okay? So if you lost money today, that means your trading was bad and you suck as a trader. This is the way people view things. So if I made money, I had a successful session. If I lost money, I had an unsuccessful session. It sounds logical, makes sense on the surface, but it is absolutely the furthest thing from the truth that you can physically imagine. We're going to liken this to a game of poker for a moment because I like poker and it's a good analogy, okay? So we'll break down why good trades are not always winners and why bad trades are not always losses, okay? So in a game of poker, 7-2, 7 deuce, is known as basically the worst hand that you can get. and pocket 10, so 2 10s would be a good hand. Now, in general, the person with the pocket 10, if these two people went all in against each other, so they both put all their chips in the middle, the person with the pocket 10s has around an 8 out of 10 chance of winning all the money, whereas the person with 7-2 has only around a 2 in 10 chance of winning all the money. So, going all in with 7-2 versus 10-10 is a very bad idea. But sometimes, the board will run out in a way that actually makes that person win. Right? So those 2 out of 10 times, the person with 7-2 will beat the good hand. That does not make it a good play. You will lose everything 80 out of 100 times by playing this terrible hand in this terrible way. So even though it won today, it does not make it a good hand. This is the same in trading, right? A bad hand that works this time is still a bad hand. It doesn't matter if it made you money. It's just like a bad trade. If it works today, it's still a bad trade because if you do it enough times, you will lose everything that you've got. Now, on the flip side of that, if we look at people saying losses are bad, the person here with 10-10, your opponent, they made the right decision. They got it in good and they should realistically win, and 8 out of 10 times they will, but they still lost. Does that mean they should never do this again? No, because 80 out of 100 times this will work. So even though it lost today, it's still a good play. And we can liken that to trading again. If you took a trade that was systematically proven through your testing to work and it made you lose money today, that does not mean it's a bad trade. So losses are not always bad and wins are not always good. You can get in, you can get the money in with the worst trade ever, and you can win. And that does not mean that it's a good trade, and it does not mean it's something you should do again. You can get all the money in with the best trade ever and it can still lose. But that doesn't mean you should never do that again. It means you should continue to do that because over time, that is the profitable play, okay? So the desire to be right is kind of ego-fueled, and it drives people to think that making money is good, losing money is bad, but without really thinking about what is causing the win or the loss. What you need to do is stop judging the quality of a trade off of the dollar outcome today. Good trades can lose and bad trades can win. You need to stop worrying about being right and feeding your ego and trying to win 70 or 80% of the trade you take, and focus on that expectancy, that plus EV trading that we discussed earlier instead. Now, an extra point is, you are going to lose 40 to 50% of all of the trades you take, even if you're a really good trader. That is just the fact of the market. So getting angry about losses makes absolutely no sense at all. Here's a quote from Peter Lynch, which if you've watched my videos for some time, you've probably seen me repeat many times over. And that is, in this game, if you're good, you'll be right 6 times out of 10, but you're never going to be right 9 times out of 10. Now, this guy made ungodly sums of money in the markets. And even he said this after decades of trading and being one of the most successful trader investors of all time. If you have an anger at losses over this, you're going to break your discipline and dig yourselves into holes when even the best traders in the world know you're only going to be right around half the time. So if you are trying to force yourself to win every time, you're going against what some of the most successful traders ever said, okay? And here's another one from Richard Dennis. You can be wrong more than half the time and still make a fortune. That means you can win 4 out of 10 trades and still make a lot of money. And of course, we do this by risking $1 to make $2 or more on the winning trades. And we're going to talk more about this later on as well, okay? So understand that being right does not equate to making money. You can be right or you can be rich. Trading is a numbers game of balancing profit and loss through probabilities, and you need to focus on extracting a lot of money from the wins you take and not on how frequently you win. You don't need to worry about losses. You don't need to try and force every trade to be a winner. You don't need to be angry at losing trades and happy at winning trades. You just need to make sure you are making the right decisions and then extracting as much money from the markets as possible when trades go your way. So now, reason number 5, and this one arguably the most important, but everything else kind of comes into this, and that is the lack of a good system. Now there's a few elements to this that we need to discuss. First of all is you probably don't have a profitable systemized way to trade, which immediately means you're going to lose, or, this is the kicker, you do have one, but it doesn't work for you. So let's start here with the broader breakdown of systems, okay? To make money in trading, you need to consistently make positive EV actions, right? You basically just need a way to repeat the right decisions over and over again enough times that it turns into money. So what most people do is they collect a bunch of random concepts, that overlearning we discussed. They apply them randomly into the markets, and if these 3 confluences stack up, I'll take a trade. And then they hope that something works, and most of the time it doesn't. That is what stagnates you, gets you moving sideways. You might have some good weeks, some bad weeks, but you never really make any meaningful progress in your trading. See, if we want to consistently apply positive EV actions to break out of this and start moving to the upside, we have to have a process that can be repeated over and over again so that it prints that positive expectancy over time. Now, the best way we can do this is to build a rules-based system. So this is what my general trading looks like and what it is that I teach people to trade like so that they can win as well. You analyze the market, you see if your setup is present. If it isn't, you don't take a trade. If it is, you check if your entry criteria is met. If it isn't, you don't take a trade. But if it is, you check additional consideration like economic data or anything that may influence the trade. And if all of that works out as well, then you take an A+ trade. If it doesn't and none of the conditions align, then you simply do not take a position. So what we do here is we turn trading from guesswork into a repeatable system that we can just come to the markets every day and apply, and it will print a good trade for us. It removes guesswork, levels out the ups and downs, ensures long-term reward, and it actually makes trading easy, or as close to easy as we can get, because when we have that system, our day just becomes rinse and repeat. So you need a system to win, right? But some of you will be like, well, I have a system, I learned a system, I bought a course, I watched a YouTube video, but here is the problem. Not every system, even if it's profitable, is actually going to work for you. And a lot of people don't think about this point. But a good system, realistically, in theory, should work for anyone. But in reality, it doesn't always work like that. There are a few variables that can ruin things for you. So if you think about how systems are built, right? A system generally works for the person who designed it best. So if you've learned a rigid 9 a.m. trading strategy, just do this at 9 a.m. This is built around someone else's preferred trading style, someone else's preferred trading hours, someone else's preferred timeframes, and someone else's preferred assets. So when you run into one of those just do this at 9 a.m. systems, there's a few problems. What if you're in a different time zone? What if at that time of day you're taking the kids to school, or you're at work, or you simply just don't want to trade at this time of day? Well, if this is the case and your schedule, your lifestyle, and your trading preferences don't align with theirs, you can't reliably follow a system that doesn't work for you in your lifestyle, commitments, and trading hours. But there's an even bigger problem with these kind of cookie cutter, just do this systems. And that is the why behind the actions that you're meant to take. And I think this one will hit home for a lot of people. So when we see one of these systems that tells us to just follow this pattern at this time of day, the question comes into our mind, but why though? Why are we actually doing that? If you don't fully understand why you're taking trades with 100% conviction behind the moves, you will hesitate, you will miss trades, you will exit trades early, and you will destroy the edge that the system has because you're too worried or anxious or stressed to actually take and hold the trades long term, which makes complete sense because if you don't know why you're taking the trades, well then how are you going to confidently put your money on the line for it? Well, the way that we can fix this, which needs to be done, is to develop a system that works for you. So we need to think deeper than just the statistics of the system and make sure we're considering something that's going to fit your lifestyle, the way you want to trade, the time of day you're available, whatever time zone you're in, and all of these different factors that kind of personalize trading and make it your system. Now, the thing that I'm going to show you, we're going to go very deep into this, is dynamic narrative trading, which is basically just a fancy name that I've given to the style of trading that I've found to be the best for myself and all of the people that I've taught to trade. Okay, so this is a way of repeating positive EV actions that can be adapted to pretty much any approach in any person. Now, what if instead of deriving the plus EV actions that we have to continually repeat from random patterns or formations that you learned on YouTube, where you're boxed into strict rules and you don't really know why you're taking the trades, we instead derive the plus EV actions from a deep understanding of the story that the market is telling you? What if you learn to see the battle between buyers and sellers and use that information to make high conviction informed decisions as to when to buy and sell? That way you could eliminate indicators, chaos, and arbitrary methods and instead focus on clean charts, because when you look at a clean chart, you know exactly what the market is telling you. You know who's in control, and you can use that information to take good trades. See, when I look at a market, I don't see patterns and I don't see signals. I see what is actually going on behind the scenes. So in a market that looks like this, I will see strong buying pressure moving the market to the upside. And these tiny sideways pullbacks that we get indicate that the selling pressure here is incredibly weak. What does this tell me? It tells me there is more buying than selling at willing levels taking place in this market, which means prices increase because people are willing to pay more than they are willing to sell for. When I look at a market like this, I take a look at the lows breaking, the highs holding, the size, direction, and speed of the movements taking place, and I can determine who is in control of this market and exactly what is happening behind the candles. This gives me maximum conviction to take trades in the correct direction. And then I turn this system into an if this then that rules base. And this is where we actually take the deep understanding of the market and turn it into a systemized approach. So as a broad example, if we take a look at this chart, we can see the market is shifting lower, sellers are dominating this market. We definitely want to look to sell this from the bias that we collect by reading the market story. Now, what we do to systemize the market story is we set up scenarios. We say if the market fails to close over the highs and then it reverses through the lows, then we will sell this reversal towards our low target. But if the market breaks over the high, then it will buy into supply. That will be where we will look for our opportunity. And then if it reverses from the supply, then we will sell it to the original target. So what I've done here is create scenarios around whichever direction the market goes, living inside of the bigger bias that I've created. And then we just say if the market doesn't do either of these things, then we simply won't take a trade. Now, this style of trading is 110% conviction trading because you have read what the story of the market is. You know who's in control, whether it's buyers or sellers, and you know which way the market should be heading based on real logic instead of just patterns and indicators and guesswork. Now, this style of trading as well is not something that you can just do on one chart. You can take this exact same way of thinking and you can apply it to any market, any time frame, and any style of trading without breaking the systematic nature of it. Because you're not memorizing patterns anymore. You're actually reading the story that the price is telling. You're reading into the battle between buying and selling, and that's applicable in every market on every time frame. Once you understand that story, it doesn't matter whether you're on the 1 minute or the daily, whether you're trading Forex, indices, futures, stocks, or anything else, the process remains completely the same. Because at that point, you're not reacting to price anymore. You're understanding price. You know why a move is happening. You know what would validate it, what would invalidate it, and then you can execute out of that. So instead of guessing or hoping or having those anxious, hesitant trades, you're making clear, informed decisions as to where the market's likely to go, and then setting up predefined scenarios to execute in that direction. Now, this system that I've just explained to you exists. You go through a deep reading of the market story and you systemize it into a repeatable flow. It's workable across any time frames. You can swing trade or day trade with it. You can trade any asset you want, and it's all bundled into a simple week by week process. Now, it sounds pretty insane that this is possible, but it is. And it's a system that has helped people that I've taught to reach payouts like those, okay? Now, if we consider everything else we've discussed today, the overlearning, the outcome focus, the emotional shortcuts, and the desire to be right, along with the lack of a good system, all of these things that have been keeping you stuck can be fixed with one good system that eliminates all of these problems and systemizes your workflow into something that works for you personally. That style of trading should be dynamic narrative trading. Now, this sounds like some fancy buzzwords, but I'm going to break down what this is today. Starting with dynamic, this basically means it can be applied to any asset, any time frame, any time of day, and any trading style without actually breaking the systematic nature of this system. Narrative means we are deriving our opportunities from the story the market is telling us, instead of following arbitrary patterns, indicators, and cookie-cutter strategies. When we finish this class, you will have a systemized process that you can easily apply every week that gives you maximum conviction behind the trades that you take, and that can be adapted to day trading, swing trading, any session, any asset, however you personally want to trade, because that is an important element of sticking with the system long term. We're going to start with exactly how I found this out and how I worked this out, and it was actually through a book called The Market Wizards. This is basically interviews with some of the greatest traders, investors in history. I've been losing a lot of money in the markets, and I found this book, and I hoped it would give me a strategy or something I could do where I could copy what they're doing and actually then start making money. Well, I didn't really get that, but what I did get was something very simple and very effective, and it actually changed the way that I saw the markets entirely. See, all of these different traders that were interviewed that had made significant sums of money, some of them billions of dollars, were trading different assets, different markets, different timeframes, and different levels of capital, and they were operating with different personalities and preferences. But they all had the same foundation in place, and that was all of them operated a repeatable, rules-based system, and you need one of these. So if we think about how money is made in trading, it is simply made by repeating plus EV, positive expected actions, right? Which basically means if you have a system with a 1 to 2 risk reward ratio or more, meaning you're risking $1 to make $2 on winning trades, you win around 50% of the time. So you're essentially flipping a coin and winning more on the winners. This is your edge, right? When you have this edge, you apply it over and over and over again. So you find out what it is that will allow you to take these trades with these outcomes, and then you just do that and you do nothing else. And over time, that will lead you into the positive. And you can't choose your exact performance results, but if you follow the plus EV action system, you will turn out with returns in the end, okay? Now, if you don't have an edge, everything is left up to luck, and you can win for some period of time through pure luck, but you're basically gambling your entire future on this, and it's not going to work for long. Eventually, things will fall apart if you don't have an edge in these markets. So if you want to achieve the plus EV, the positive outcome, you need a way to consistently repeat those plus EV actions that make the winning trends happen. And that is why we systemize, so that we can do the same thing over and over again that we know long term will give us a positive result. So to do this, we are going to build out a rules-based system. We want everything to be systemized into a start to finish flow. We analyze the market, we see if a setup is present. If it isn't, we don't trade. And if it is, we check the next thing, that is entry criteria. If that's not met, we don't trade. But if it is, we check additional considerations, anything else that may influence the trade. If that's not met, we don't trade. But if it is, then we take a position. This automatically filters all of our trades so that we only take the best of the best. This means we have the highest win rates, the highest possibility of actually getting to a successful trade outcome, and the highest rewards on the trades that we do take. It will shift your trading into a simple daily process, which has no room for guesswork, and results in calm, confident trading that actually gives you results, okay? So let's dive into narrative trading first of all. So I said with narrative trading, we are actually deriving our opportunities by reading the story the market tells us. This is way better than, for example, arbitrary systems like support and resistance, where the idea is you should buy a support floor once the market has traded over it. Now, this can make you some money, but the big problem with this is that you don't really know why this is happening. Why exactly should this invisible line that you've drawn on the chart actually give you a winning trade? What does it even mean that this has taken place? Likewise with the cookie cutter systems, the systems that tell you just do this at 9 a.m. Why though? What is it exactly that's telling us that this is going to lead into a winning trade? Now, when we don't have confidence behind the system we trade because it doesn't really make sense to us, or we don't really understand the mechanics of why the market is doing this, we can't really trade this with confidence, meaning we'll be stressed, anxious, and hesitant in every trade you take. And when you feel that way, you skip trades, you close trades early, and you make bad decisions which overall destroy your edge. See, a standard trading system, when performed well, should realistically look something like this, right? We don't have a linear drive up in trading. We're going to have losing trades, we're going to have winning trades. And your performance may look like this. You take a few losing trades, then you take a nice big win, take a couple more losing trades, and you take a nice big win. When you understand your system, this is easy to do. But when you don't fully trust or understand the reason why you're taking the trades, what you can often do instead is take a few losses and then hesitate because you're on a losing streak and you don't trust the system. You see a setup, but you think this one's just going to lose, so I'm not going to take it. So you miss the win, and then you take more losses. You hesitate out the next win, and you take more losses. And before you know it, everything you've worked for up to this point is completely gone. You failed your funding challenge, you've lost all of your account, nothing is working out, and you're just digging yourself into a hole because you're just too worried to take the trades that can actually make the system perform well long term. So what we need to do is break you out of your beginner mentality of trading a basic checklist strategy that you don't really understand, following it blindly and then stressing every time you're in a trade, and move you into a pro trader mentality where you can read markets deeper and clearer than you've ever seen them before, and then confidently systemize that into a process that allows you to execute calm, consistent, winning trades, okay? The narrative part of this system is all about reading the market story so that when a trade goes against us, instead of thinking, what do I do now? We are left understanding exactly what the market has just told us to do. And now we think, okay, yes, that trade lost, but this has opened a new opportunity because I fully understand what the market is telling me from the ups and the downs, the wins and the losses that it's actually creating for me. So what you need to do first of all to trade calm, confident, and successful long term is build that level of market understanding. So let's start with a question. When you open a chart, what is it that you're actually looking at? Now, a lot of people will say they're looking at price, candles, levels, and patterns. And sure, these things are present on the charts, but they're not really what the market is all about. See, when I look at a market, I am always weighing the seller and buyer control. So markets go up and down because of willing buyers and willing sellers. If a market is moving down, this means there are more people here trying to sell this market, then there are people willing to buy. So the sellers have to drop the price to entice the buyers to actually take up the other side of their position, right? It's like a big auction. Then, if we start to see the sellers weaken and we see the buying coming back in, this simply means that buyers have found interest in this market and they are buying. And those sellers can now say, I'll sell you the asset, but I'm selling it you for a higher price. This is what drives the market to the upside. Now, when we see things like this, where the market breaks out of a high, but then it reverses immediately with pretty strong selling pressure, this is actually an absorption point where the buying has been totally taken over by the selling. So when the market reaches this high level, buyers are exiting in mass and sellers are entering in mass, right? These can be short sellers who are looking to profit from a downward move. And then when this leads into a seller-dominated market, I can see all of this happening before it takes place. And now I can even use this as more information to take continued trades, because what I'm doing is I'm reading that battle between buying and selling. I know who is in control of the market, and I know where the core points are that the market is likely to reverse or continue with strength. Okay, so all you are looking at when you see a downward moving market is that there is a volume of selling larger than the volume of buying. And now let me explain this just real quick, because this confuses people. Obviously, to take a trade, there has to be a buyer and a seller on either side of the position. You can't buy if there's no one to sell to you. So it's not that the volume of buyers is larger than the volume of sellers in a market that's moving up. What it is a volume of buyers willing to pay higher prices, okay? So if a seller in this seller-dominated market wants to sell their asset, but the buyers are not willing to pay this higher price, then there are less willing buyers than there are willing sellers. The sellers therefore have to drop the price to actually match a price that buyers will be happy to pay. Okay, that is how it works. So it's about a volume of willing sellers in this market is larger than a volume of willing buyers at these specific prices. And as prices do decline, then we will have more willing buyers stepping in. And that is why after large downward moves, we see these larger reversals, because people say, okay, this price is pretty good now, I think I will buy. And then sellers stop wanting to sell, or there's less sellers left to sell. So they will start saying, I'll sell at you, but I'm selling at you for a higher price, right? That is the kind of auction theory that the market runs off. That is what you need to understand to really read these markets deep. So when it comes to narrative, a narrative is a structured reading of what the chart is telling you, who is currently in control, what would confirm that, and what would change that. When you trade in a narrative-based way, you actually create an opportunity, and then multiple other opportunities can stem off of that opportunity. So rather than marrying one bias and saying, this is my trade, this will work, you basically build a picture as to what the market looks like it can potentially do. You work out who's in control, which way the market's going, and where those points of interest are. And then you stem multiple opportunities out of one narrative, which is what makes it so powerful. So really quick now, let's jump to the chart, and I'll show you kind of how we read this story between buying and selling in a market. Okay, so how this narrative trading works then is what we're doing when we're looking at charts is we're trying to determine overall who's in control of the market and where is that story likely to lead us. So if we look at this USD JPY weekly chart, we can determine just by looking at this weekly that the most recent move we've had is an aggressive impulse to the upside from this low. We then had a stall out so far, pullback, but no break of any meaningful lows here. And now we're driving back up with strong momentum again. So if we consider basically the battle between buying and selling, we can see that every time we've reached this level, we've seen aggressive attacks from buyers. Now, this second one wasn't as strong as the initial one. However, this third drive we've had is actually pushing us through these highs towards basically the open area, which would target this next high. So if we think about what that is actually telling us and what this is behind the scenes of just patterns in the market, we basically see buying has been incredibly strong on the US dollar versus the Japanese yen. Okay, for whatever reason, there are macro reasons for this, but we're going to keep it technical focused for here. And every time we've attempted to come lower again, even after this aggressive sell-off, we've continually pushed back up. Now, what this is basically buying is willingly taking place at higher prices consistently throughout this upward move. Then, for whatever reason, we had this dramatic selling move. However, the failure to get back under this low, and considering this is an uptrend overall, right? The failure to get back through the low here shows that buying is still stronger than selling in this market. Because if selling was indeed strong enough, we would have seen the market push through the lows that have previously been set as a floor by the buyers, right? We would have seen less people willing to buy at these prices, selling continue, all of these buyers that bought previously selling in, short sellers selling in, and basically we would have seen that close lower and then likely lead into further downward prices. However, what we've actually seen is every time we've reached this level, this has been a kind of floor that buyers have set in place. And this price range around 140 is essentially a price point that buyers are very happy to snap up massive amounts of these contracts at. So every time we reach 140, we see a massive new influx of buying and buyers willing to buy at higher prices back in towards the highs of the range, right? So from a buying selling perspective, we are basically told by the presence of this low that we've just mapped in around 140, that buying is very happy to take place above the 140 level, and buyers and general market participants basically see 140 as a viable floor for this market that really the market shouldn't trade beneath. So that's step one. Now the next thing is, of course, momentum. We can see these upward movements are very strong. Now this initial selling movement is very weak, but that is supported by what we just explained as that psychological 140 floor, price floor, that people don't want to see the market go through there, because every time we get there, we snap up buys. Now, this impulse to the upside is very strong. How do we know that? Well, the size of the candles and the speed that we completed this movement in, okay? When we had the pull back, if we take a look at the candles on the downside, these are smaller bearish candles than the ones that drove us up. We also see from the wicks that we're continually attempting to go back higher throughout the downward move. And here, where we have this kind of chop, this is basically buyers pushing back. So we still see, even in the downward move, that we have willing buyers coming in. Now, when we reach the low, what does this tell us? Well, the fact that we closed higher here than we did previously shows that there is more buying pressure and buying intent coming in at this point than there was here and that there was here. And this wick tells us that this is, again, that solid floor. Every time we get lower, the market is driven higher by significant buying. If we then lead into the buying move, sure, it started out weak. However, we pretty rapidly progressed in this move. And this quick movement and basically the failure to get any lower from the sellers indicates to us that buying is alive and well in this market. And that is what's leading us into where we are now. So if we take a look at the current position of price, this has actually taken out a previous high, only with a wick at the moment. However, just in taking out this high, so with this price move here, this indicates that buying now is stronger than buying was in the previous attempt to go higher. So we've actually driven through a high, which shows more willingness from buyers to buy at higher prices than previously. Then take it to where we are right now. We had a pullback, which was a pretty dramatic one. However, even more interestingly, is over the past 3 weeks into this analysis, this bearish candle has been completely taken out with this slow progressive bullish price action, which this progressive price action has no bearish pullbacks in it, right? It's one clean drive from there to where we are right now. Again, with this breaking through the high, indicating buyers here were willing to take it higher than previously, we're getting a sign of strength again. So it's all about reading the story of what the buyers and sellers are telling us in the print of the candles, okay? So if I were to look at this market, I would presume the most likely outcome will be a continuation on the buy side towards the high, because we're moving in an already bullish manner and we are showing that the buyers are continually basically outpacing the sellers. We have buying setting a very clean floor, very aggressive rejections when we get to that floor again, and then clean buying taking place right now, breaking us through previous highs, showing more willing buying taking place at higher levels. So if we take a look at this on the daily, we can see, again, very similar kind of movement, right? We have this strong upward move. It's a little bit slow, but this is that weekly movement that was going on for a very long time. Then we have a very aggressive sell-off, which generally this will be a bearish sign and will tell us that sellers are stepping into this market in massive force. However, as soon as we had that selling move, we printed our low around 151. Then the market had a very aggressive drive back up. And when we attempted to go lower again, we actually failed. We closed higher. The wick didn't even push through the low, which indicates that sellers here are not as strong or willing as sellers were here. So when we see this aggressive price action again, which once again drives us through a high, showing more willing buyers at higher prices, this is an indication that this market is likely to continue trading bullish. So how do we turn this into opportunities? Well, if we think this market's going to keep going up, we can look at the high near term, and then what we can do is just map out the potential areas for this market to actually buy from. Now, I would look at these points initially, and we can go down lower to say the 4-hour time frame to really refine an idea. Okay, so we have now basically in mind that the market is indeed bullish, and we're being told that by the market participants themselves, by the way the candles are printed, right? This was our very low point after a dramatic sell-off. we managed to pull back a significant way, and then what would have proved us bearish, which would have been a closure under this low, failed. We created a higher low. Now, in terms of structure, not entirely valid higher low, but in terms of the actual market participation, a low higher than the previous one, indicating that sellers are weak, buyers are strong, and then we drive up through the high, further backing that idea. So if we zoom in the 4-hour perspective, that's just going to be a simple trend like this, and what we can look to do is just join this movement up, right? So from a trend perspective here, we would look at the highs and the lows that have been printed. We have a high, and then this high breaks through at this point to print a new high. Our pullback on this movement is around this low. That's going to be our low. The fact that the low here is higher than the low here, again, tells us that buyers are trending to the upside over sellers, which means more buying pressure than selling pressure. And then in theory, the market shouldn't, if it does remain strong, shouldn't go under this level. So it should basically remain above this low, which what would that do? That would validate buying strength, because that would say, okay, the buyers clearly have a basically root of control here. And if they hold that, buying above this level makes absolute sense. And if we get under that level, then that could be sign of shift into seller control, which could mean we trade lower, right? So what we're doing is we're not just looking at patterns, we're reading what are the market participants telling us through the candles. Now, a trade that I took was simply this area of demand here. We had what I classify as like equal low liquidity. So basically what looks like a support floor in the market. We know there's going to be lots of orders under here. Again, this drives back to that market psychology. So if you've been buying at this level or at this level and you're a basic retail trader, you're going to have stop losses under the low. Now, because there's lots of stop losses under the low, there is a significant amount of orders here that the market can take the other side of, essentially. So if we're able to drive into that big collection of orders towards this kind of core point, this demand zone, we know there's going to be lots of buy orders waiting here. If we think about what the stop losses are for buy trades, they are sell trades, okay? So we get lots of sells triggered here. They can be absorbed into buys, and then even more buying pressure in the form of this demand. Basically, these being prime points for massive buying absorption to take place. Pair that up with the fact we've already built our bias narrative to be bullish, and we can see this as a very simple trade to be taken, okay? So now, if we run that forward, you can see that is exactly what happens and how the market plays out. It came back down, traded into this zone, and then ended up rallying to the upside. And again, another trade I took, and I'll post these up in just a moment, was actually from this demand. So you see the same exact pattern occurred. We created a demand zone, which had some slight imbalances into it, 1, 2, so equal low liquidity. We came back down, traded into that area where buyers typically absorb orders, and then continued moving. And we did this because we built that big picture context, all right? Now, for some traders, they may see this shift here as a break of structure and start looking to sell the market. But if you've got the big picture context, if you understand who's in control of this market, selling there makes no sense. And you should be following the buy side ideas that I've just explained to you. And that's pretty much how I find them, right? It's contextual narrative building around the market. It's reading into the speed and the size of candles, but not just in isolation, but in terms of the larger movements and the pullbacks we see, the highs and the lows holding. All of this gives us information as to who is in control of the market. A movement like this, very strong upside, slow choppy downside, very strong upside, slow choppy downside. This tells us weak selling pressure in these points and strong buying pressure in the impulsive moves. When that is taking place, we know buying is taking place more willingly in large volumes than selling is. So therefore, we should look to join the buyers and continue until they lose control of the market. Okay, so that is a general overview of how we do this narrative-based trading and how I read markets myself. Contextual, it's top down, and it's all about reading the story of the market. And as you can see, those two trades followed through. Over that 1 week of price action, you get a couple trades there, which runs you higher into the targets and further validates that bull idea. Cool, so that's it. We're going to draw back to this in full detail in a moment, but let's jump back to the slides for a moment. So to trade with confidence, we want to answer 4 questions from our analysis. Number 1, who is currently in control of the market? Number 2, what confirms this expectation? Number 3, what would invalidate this idea? And then number 4, where do the trades come from as a result of all of this? Now, the problem most traders have is they skip all 3 of the first steps, and they immediately just look for where are the trades, okay? You jump to the markets and you're just fishing for any opportunity you can find without building bias or context or an understanding of what it is that the market is doing right now. So you need to build bias before you execute. Now, if you've ever been on a low time frame chart, and you probably do this quite frequently, like the 5-minute, the 15-minute, or really any chart actually without bigger picture context, you might be left completely confused. You look for any opportunity for supply zones, demand zones, whatever it is you trade, you buy and sell them all, none of it works, and you lose loads of money at the end of the day or week. The reason for this is that charts at these timeframes, or realistically any chart without a big picture context behind it, they lack major context, right? You're not seeing the big picture, you're not seeing what's actually going on, you're seeing short-term speculative moves, you're trying to trade that, and that is where you get whipsawed around and killed back and forth on buy trades and sell trades. Now, when you bring in a big picture context and you read the narrative in the way that we've just explained there, you know what to ignore and you know where the real selling and buying points will be. So you can stop focusing on short-term tiny movements. So you can stop focusing on tiny insignificant moves, and you can start focusing on the real buying and selling points in the market, fully understanding where those points are. So the shift that you need to make, the shift that I've made and thousands of my students have made, which actually got them profitable, is to stop looking for a trade. What you're doing is you're looking for the narrative, and then you wait for the market to say go. The market will tell you when to take positions, okay? So instead of trying to predict the market and fish for trades, we just want to map out the possible outcomes based on the bias and context we build, and then build predefined scenarios for how we will approach each outcome, right? That if this, then that format that we discussed in the last class. So if I was to see this market, and we have some open imbalance and a demand zone below, but we can see at the moment that sellers are clearly in control of this market, I would say if the market returns, there's only really 2 things that can happen. The market can pull back and then sell down towards that level, or the market can trade up and break through that level. Now, it could also go straight to the target, and that would just mean there's no trade. But these are the 2 predefined scenarios that would actually give us an opportunity, right? Then what we would do is simply say, if the market reverses inside of this range and confirms shorts, I will then sell down towards the target I've got. And if that fails and the market trades above, then we can look for reaccumulation and buy through the larger imbalance to the upside to the next supply, where maybe the market will sell from just then. So we're actually prepped on both sides of the market. And what we're doing is executing predefined scenarios instead of reacting to any tiny candle that happens in real time. We're just executing decisions that we've already made. Now, the powerful thing about this is when you move over to the markets and you're staring at a chart and you're trying to fish your ideas out, instead of thinking, what should I do right now? What we're doing instead is thinking, what are the only things that can happen? And what is my plan for each of those things, okay? It means you can hit the market, both sides, and you don't have to stress or guess at trades. You just follow that if this, then that flow. And if not, if it doesn't validate, then you don't take any action. This is how you can catch the market both ways instead of being married to a bias through multiple losses when things don't go your way. All right, what we're gonna do now is go through a trade that I took in March on GBP USD. And what I want you to do is kind of detach your mentality from the way that we'd usually view charts, where you're looking at patterns and trying to kind of formulate ideas without thinking about context, and listen to how I explain the way that I see charts and what it is that I'm actually looking at, okay? Because this will be a big step in your understanding of the markets and therefore your systems and performance. So we're going to start on the weekly. I always start top down with my personal trading, because if I'm on the weekly time frame, I can get a general broad idea as to where the market is, what the directional bias is telling me, and likely a range that we could trade within, okay? So by taking a look at this weekly time frame, we see this is obviously quite an impulsive bullish market up to this point. This tells us buyers were cleanly in control. When we reached this point here, we started to see that buyer control soften. We had sellers coming in, and we've kind of failed and struggled to get back up again in terms of significant buying. Now, one of the most significant things here is if we take a look at this high, we had an impulse up to this point, and then in this week, a significant reversal from sellers, which drove us all the way back down here. Now, this is a really strong potential reversal sign, because if we think about what this is telling us behind the candles, right? We saw that buyer strength softened at this level and has basically pushed the market into this range. But this rejection shows, again, very clear control from sellers coming in when we kind of reach that we could call it a price ceiling that has been set by sellers. So buyers are just not so happy to willingly buy massive quantities up here. And sellers, of course, are very happy to sell because this is a premium price. So if you're selling or offloading contracts that you bought, this is the most profitable point to do that. So you sell it when it gets back through the highs. If you're short selling the market to profit from a decline, this is obviously a very profitable point to do that too, because we're so high up that now if the market does reverse lower, you're getting a significantly better entry up here to profit from the decline than you would be if you sold anywhere in around these levels. So this is basically a core point for sellers to start entering the market in force. And we see that because after the big rejection, we see continued seller domination. So when buyers see this rejection, they are now no longer too happy to start buying in numbers. Buyers want clean, impulsive moves like these, right? If we see a rejection like this coming from a high, this can easily be a point where the market starts to reverse. So we saw buying soften and selling kind of strengthen up in and around this range. And then that was somewhat confirmed as we pushed through the high and then reversed immediately into a phase of seller domination. Now I want to draw your attention to this low. So this point just here. Now this is not a massive important structural low, but it is an internal low within this leg of price. And if we consider what the break of this, which is taking place now, is telling us, it's basically telling us that buying, okay, here is weaker than buying was here, because buying was strong enough to drive us to an impulsive high, and it wasn't strong enough right now to actually hold the low that was created by that impulse. So by pushing through this low, we're basically getting further indication that sellers might be weak, and this market might be likely to lead lower. So if we factor everything that we've put together so far, we have softening buyer control coming in quite a while ago, actually in June 2025. We've then really ranged and not managed to push significantly higher for almost a year. And then when we did manage to get higher, it was immediately reversed by sellers with a massive wave of selling pressure, completely dominating the buying moves, absorbing the buys, and driving back lower. This then led into a break of an internal low, which again just indicates to us that sellers now are stronger than they were previously, and buyers now are weaker than they were previously. So we're getting a good idea that sellers are likely in control of this market. Now, with that in mind, we can take a look at the daily and start to assess exactly what's going on from a daily perspective, okay? So what we can see immediately is that huge bullish impulse that we had has been taken out, and this is what that wick was on the weekly time frame. We see a big rejection which is driving the market back down and again pushing us through this low. Now, an interesting point is that we haven't closed through the low yet, which could say that maybe we end up rejecting and going higher. So that's definitely something we can keep in mind. Now, in order for that case to take place, we would realistically need to see a high break. And that for me would be this high, because this current downtrend that's taking place on the 4-hour, or the daily, is being capped by the high. Now, in markets, when lows break, that indicates seller control. And when highs are maintained, that indicates, again, another level of seller control, because buyers are not strong enough to get through previous highs, right? Means basically there are more people trying to sell assets and willing to sell assets at these prices than there are people willing to buy at higher prices. If we saw the high break, that would tell us that buyers are actually starting to get interest in buying this asset, even for higher prices. So therefore, we could shift into possibility of buys. But as it stands right now, the sellers are maintaining the strength and the buyers are maintaining weakness. So we would say the market remains bearish, providing it stays underneath this high. Now, another important thing to assess is these wicks, because as we know, wicks do indicate rejections, which shows there is at least some buying pressure coming in from these lows. We have to then ask, where is this coming from? If we take a look over to the left, we can see that there is a demand zone down here. Now, what is a demand zone? It's basically a range before an impulsive move, okay? A buying move for the case of demand. Supply is the opposite, so it's before an impulsive downward move. And what supply and demand shows is, in the case of a demand zone, an area that buyers were willing to buy the asset, or a price level that buyers were willing to pay for an asset previously. Therefore, we know this is seen as a discount price. Buyers then, if this level is met, will likely want to take another stab at buying this market, okay? So that's what a demand zone is all about. Supply zone is basically the opposite. If we look at this zone here, it's consolidation before a downward move. Generally, supply zones is sellers were happy to sell here before, happy enough for this to actually break structure, which tells us that this is seen as a premium price for sellers. They like this zone to sell from because, again, you're getting a good price if you're selling your contract, and you are getting a good entry if you're short selling for a profit on a decline. So that's a premium price. So we could expect that if we get into that range again, sellers therefore will be interested in selling down. So it's all just about identifying where previous significant buying and selling took place from, and then using that as an understanding that this is probably a point of interest. If we get there again, we're pretty likely to start seeing the same things happening, okay? If buyers were happy at that price before, they probably will be again. If sellers are happy at this price before, they probably will be again, right? So anyway, how that actually has relevance here is these wicks, these rejections we see, yes, it is some buying pressure. No, it is not enough to start buying, because we would need to see a high break and then a low maintain. to actually validate buying, right? So buying would come in on a pattern like this. At the moment, it remains bearish. And although the buying pressure is coming in, it's actually not really coming in from anywhere significant. It's coming in from what we call an imbalance. Now, an imbalance is basically the gap between a demand zone and then wherever the next kind of point was, or where price is now. So this area that I've just marked here, this open price range, this is an imbalance. And the way that I see imbalance is basically, it's an area where no significant buying or selling is likely to take place, because the premium and discount price levels are above and below these imbalance points, right? So what I see imbalances as basically a magnet for price to draw through and completely fill before retesting a demand or supply zone. And that is where the real solid trades come in from. So what we can expect at this point basically is for that imbalance to be filled, because we know that buyers will come in force at some point. Well, if they do, it's likely going to be from a discounted price level or a demand zone. So we could say this is reasonably likely, providing and considering that we maintain this downward trend where we maintain highs and break lows, okay? So we have from the weekly the idea of potential seller domination reversal, big weekly rejection, big drive lower, sellers are currently in control of this market. From the daily, we see a continuation of that in a tighter format where we see the lows breaking and highs maintaining, which again gives us an idea that sellers are in control of this market, and providing we stay under this high, we should look to sell. We see the buying pressure rejections, which is some cause for concern for the sell bias, but when we line up where that's coming from, imbalance, it's really not a significant point that's likely to attract too much attention for buyers. What's more likely is we will at least get to a discount price level. So if we get down into there, then we can worry about the market potentially reversing. But until then, we should realistically remain on the sell side. Okay. So what we're doing is we're reading that story endlessly and just working out who is currently in control of the market. Okay, so dropping to the 4 hour. 4 hour and below is generally where I start to find opportunities. And as I've explained, we can do this on the weekly, we can do this on the 4 hour, we can do this on the 5 minute. The narratives, because they are following the real story of price, they work everywhere. Okay, it doesn't matter if you're on the 1 minute, it doesn't matter if you're on the hourly. These setups all work in the same way, because the way we're reading the market is just reading into them basically the psychology of buyers and sellers and the patterns, the phases they go through, right? So what I'm going to do on the 4 hour, first thing I want to do is, of course, we have our marked in high. We know the market's not likely to get past that. And if it does, that would open up one of our if this then that alternative opportunities. We would say if the market gets over this high, then it's probably bullish because we're seeing a pushback from buyers, so we can buy. Okay, so that's the if this then that alternative buy situation. But unless that happens, our focus is going to be on selling this market down towards this area of demand. So that would be basically the basis for the primary trade that I would look for. And what we have here is a selection of things. Number one, the supply zone. We know this was seen as a premium price to sell this price at before. Therefore, it's likely to be seen as a premium price again. Number two, imbalance. Again, this one has a gap. This gap is likely to be filled. That will draw us into the area of supply. And then basically the supply zone being the premium could be the point where we start to see a shift from the sellers regaining control over this short-term bullish move and drive us back down towards the low. So we have here maintain downward price action, a premium price zone that's likely to be a good catalyst for sellers. And then we have our downward targets basically pushing us into this low. So targets wise, we can look at this low here. And we can look at the demand zone beneath, as that's going to be kind of the next magnet point for price. Now we can also see the market is pushing through one of these internal range highs. This is what we classify as liquidity. So this is kind of a key point where basically anyone who's sold from this level below, trading with, standard rules, is going to have a stop loss somewhere in this range, or a lot of those people are. The stop losses for sell trades are buy trades, because if you think about what it is, if you are in a short position, and you have a stop loss on, you basically have sold the contracts, and if your stop loss is hit, you're buying them back for more than you sold them for, which means you take a loss, right? So it means there's loads of buy orders in here. Now, buy orders can actually be a really good catalyst for sell positions at certain points, because if we see an influx of selling coming in at the point where there is a massive quantity of buy orders being hit at the same time, we can see basically a lot of selling taking place because someone can take the other side of all those buy trades. That's what we call absorption, where all of the buying orders are immediately absorbed by selling. If we factor how that is currently lining up, we have this potential absorption point where all the liquidity is. We have a premium price zone where we know sellers want to sell from, and we have seller control overall with maintained highs and broken lows. So basically we've got a very good case for selling, right? Now we shift that into the if this then that format, and all we're going to do is say if this market trades into supply and then confirms short like this with a shift in structure, then I will sell.
That is if this then that scenario number 1. Scenario number 2 from this point would simply be if the market gets over the high here, then that shows a shift in control. Therefore, I will look to confirm and then buy. Okay, so that's the alternate scenario, and every one of my trades has one of these, because as one trade invalidates, a new opportunity generally will validate, right? So if this sell doesn't work and it does drive higher, then that's going to tell us that buyers are stronger than we thought, and maybe there's some room for us to then trade up towards some next points of supply, for example. But as it stands right now, what we would just want to do is look for that opportunity that we just prepped out. So we're looking for the market to come into this range and then give us a change in the overall direction. Okay, so we've seen the market drive up there. Realistically, what we'd want to see now would be the market coming and closing under this low. Okay, here we see rejections, large bearish movement coming in. Then we get closures beneath, which tells us that sellers are now once again taking control over the short term. So highs, okay, highs maintaining, highs being created, lows maintaining, that's buyer control. And then a low being created and failing, that is seller indication or reversal indication. Now what we would look for is simply the best point to actually sell from, which again is going to be a supply zone. Why? Because this is a premium price zone that has created an impulsive move before. It's likely then that if the market gets into there, we're going to see new sellers see this as a premium price to sell from. So our trade becomes this, and then all we have to do is place an order like that, put our stop over the high, targets down into the low, and then you've got a narrative-based trade. And we've built this out of basically assessing who's in control of the market at this point, which way that leads, and then what the entry criteria would need to be in order to formulate a trade. So what we do is we build the idea and then we just let the market come to us with the opportunity, right? We're not forcing anything. We're just saying this is the most likely thing to happen next. Therefore, if this does happen, I will take this position. And as you can see, it results in some pretty high accuracy trades. So that's basically the full flow. That's how this narrative trading works. Build out a full reading of the market, the battle between buyers and sellers, the volume of buying, the volume of selling, and which direction points of interest that is likely leading the market into, and then just set up your entry criteria. If this happens, it's telling me that I should sell. If this happens, it's telling me I should buy, and then just do nothing until one of those two things happens, and then you get A+ positions like this. So that is the flow of narrative-based trading in a systematic way. All right, so now let's bring this all together. What we're doing is we're taking an understanding of the market and we are shifting that into a system that you can run every day. The process goes as follows. First, you want to build out your narrative. This is the top-down flow that we've covered, creating clear answers to who's in control, what confirms that direction, and what would change it. This is the foundation to the opportunities that you are going to trade. Then we move on to trade execution. Form trades and execute them from your narratives by preparing all of the outcomes in advance, setting up the bullish and bearish trade criteria, and then executing from predefined conditions. Shifting your trading from what should I do into which outcome is playing out. Then, of course, we want to systemize it. So we follow the same flow, same concepts, same logic every time. We build the top-down narrative, develop a clear bias, build out the alternative scenario, so if the market goes against us, we can still find positions, and then define our execution criteria in advance so that we can just trade in that plain, simple, if this, then that format. Every trade that you take in this system is a result of a process that you've already followed. And the real magic behind this approach, of course, is that it is not tied to a specific market, it's not tied to a specific time frame, and it's not tied to any specific schedule. Because your trades are formed by reading the markets deeper and clearer than you've ever seen them before, you can do this on any time frame. The same behaviors, same speculation, the same battles, they're all taking place everywhere. Doesn't matter if you want to trade Euro USD, gold, oil, Meta, or Bitcoin. On the 1 minute, 15 minute, hourly, 4 hour, or daily, as a scalper, a day trader, a swing trader, or a position trader, it really doesn't matter. Because what we're doing is reading basically the market psychology, the buying, the selling, who is in control, what they're thinking at each different point, and how that leads into different opportunities. This is basically translatable to any asset, any time frame, because it's the real dynamic or mechanics of how the market actually moves and what it is that drives price appreciation and depreciation. So this means this system is not someone else's signals, it's not built around someone else's schedule, and it's not someone else's way of trading. It is just reading the real market drivers and then taking your trades around that on whatever preferences you want.
So you can day trade it, you can swing trade it, you can trade what you want. It's very, very freeing while remaining systemized. It allows you to shape your trading around your life instead of shaping your life to fit trading, which realistically, we're all trading for freedom, right? So you don't want to box yourself into a system and a schedule that you don't like and you don't want to follow. That's not very freeing at all. If you're going to do that, you might as well get a job. Now, in order to succeed at trading, you don't need finance degrees, loads of experience, a special personality, or tons of starting capital. You just need a clear process executed in the right order. And this is what most people miss. See, the way that most traders operate is they find a scrap of information in a YouTube video or a course, they try to make it work, get confused and hopeless, lose some money, give up, and then start the cycle again. And people stay trapped here for months, sometimes years, and most of the time until they just give up on trading one day, however far in the future that may be. Now, we need to break you out of this cycle. So I'm going to give you a 4-stage journey that you can follow, which is going to take you from wherever you are right now, whether that's a break-even trader, a very small winner, or completely down in the hole, and bring you out of that towards funding, payouts, and everything that it is you're trying to achieve from trading. So step number 1 is to learn to deeply read price and build narratives around what the market is telling you. We want to shift our trading from just being able to see things on the chart to actually being able to understand what it is that the market is telling you. Because you can read supply and demand zones, or you can see them on the chart without actually knowing whether they're relevant or important zones to be trading from. And you can see momentum for what it is without really understanding whether these are impulsive or corrective movements and whether they're relevant to trade off at all. You need to be able to sit down with a chart that you've never seen before, work from the weekly down, reading the battle between buyers and sellers, and form a structured narrative from this information. You want to answer these questions from your analysis. Who is in control of the market right now? Is it the buyers or is it the sellers? What is driving the move? And where are the points of interest that you could potentially buy or sell from to actually formulate your ideas? If you can build narratives correctly and you read the story in the way that we explained how to in the last episode, then this will all become very simple and reading the markets will be clearer than it's ever been before for you. Then we want to be able to synthesize this information into a story, determining what the story of the market is right now and where that will lead in terms of biases, directions, and where the executions will be. Now, this skill of learning to read markets deeply is more important than anything else right now. It's the one thing you need to master because everything else will fall into place when you can see the markets clearer than ever before. Now, this is a learnable skill, okay? It's not intuition. Anyone can learn how to do this, and when you do, you will never see the markets the same again. Instead of looking like a chaotic mess that you endlessly burn money in, markets will become a coherent story that consistently print positive outcomes for you. When you've done that, it's time to move on to step 2, which is where you want to build this narrative edge into a rules-based system. So when you're confident with your abilities to read the narratives of the market, you want to shift that into a process that will consistently allow you to repeat the same positive expected value outcomes that actually give you results. This means going from the high time frame through to the medium, and if you want to, the low time frames for trading, using bias, range, and points of interest. So you want to determine, what is that battle telling you? Who's in control right now? What is the bias of the market? Then ranges is, where is the market likely to go next, whether it moves up or down? That's where your next relevant trades will be, so it's important to get those in mind. And then for points of interest, inside of that range, where are the buying and selling opportunities? The points of liquidity, the supply zones, the demand zones, the points where you'll actually get into and out of your trades. We want to do this in the if this then that flow that's been explained throughout the previous 2 classes, where we build a situation or a scenario in the market and we say, if this supply holds and we get bearish confirmation, we will sell. But if this supply breaks, then we will look for a buy through towards the next area of interest on the upside. When you build these multiple scenario outcomes, trading becomes simple because you're not marrying biases and getting stressed when trades lose. You have an endless flow of opportunity. Every loss or every miss or every invalidation immediately validates a new opportunity in the opposing direction. So when it comes to systemizing this process, you want to consider, what is the narrative telling you? Where are the significant points of interest? What is the specific trigger that would get you into a trade? And where will your stop loss, your target, and where would your stop loss and your target be? And why? All of this is specific, unambiguous, and clear, and most importantly, prepared in advance. This is how we systemize trading, by prepping everything ahead of time instead of trying to react in the moment. Now, if you have a system to some degree now, and you're just worried that systems don't work because the one you're trading with isn't working out for you, that's generally because it looks like some rules on the surface, but it's weak, fragile, and prone to falling apart, and it's open to interpretation and interference in the moment. To fix this, we have to build that narrative-based way of seeing the market. Then
it just becomes a process of, is the market telling me to trade? If it's not, you don't take a trade. If it is, you execute your positions. It simplifies trading, removes guesswork, and separates the calm, consistent winners from the chaotic, stressed, and anxious losers, one of which you may be right now, unfortunately, but you can break free from that. If you nail this systemization step, everything will change for you. And when you have that narrative down, and when you have it systemized in a way, and when you've got your narrative and you've systemized it correctly, you then want to move into testing and validating your system. And if you skip this step, I promise you will lose forever. So make sure you do the work. So at this point, you'll have built your system, you'll understand the framework, and you'll have some solid rules. Now you need to ask the question, does it actually work? And can you do it correctly? That is what we're trying to do here. So if we want to achieve long-term positive outcomes and move our equity curves to the upside and build a career from trading, we need to know that what we're doing works. Otherwise, we are kind of blindly buying and selling and hoping that this moves to the upside. You can have a good system, but you might not be able to profitably apply it because of mistakes that you're making. That is what makes testing and validation so important. So the first thing that you should do is get yourself a backtesting software like FX Replay or Forex Tester and trade your system, your narrative-based system, your rules-based flow in a simulation using past price data over the long term. And you will see over that time how the system performs. And if the system performs well and has an equity curve like this, or even if it's a little messier, if it's still moving to the upside over a sample of a few hundred trades, you know for sure that this system is going to pay you. And then when you come to trading it, you have conviction and confidence in your system, which makes trading a lot nicer. And you also understand that you're not going to be trading for the next year only to end in the red because your system doesn't actually work. Now, in your backtesting, you should be tracking your win-loss ratios, risk to reward, maximum drawdowns, and largest losing streaks, because these things are important so that when you encounter them in the real world scenarios of your real trades, you know what to expect. You know when something is concern and when something is just standard variance of the system. When you've done backtesting, you should move on to forward testing. Trade with a small capital of $1,000 or less. Purely system focused at this point. We care about learning, not earning in this stage. And what we're trying to do here is basically prove our ability in real-time markets. Backtesting is fast and there's no money on the line. But when we are in forward testing, we are building that ability to actually execute the same way in real markets, in real time where things move slower, with real money on the line. This will test your patience, your discipline, and your emotions as well. But with that backtesting data behind you, it will be a lot easier to find profitability here. This stage proves your ability and builds your conviction so that when you come to real achievements like funding challenges and reaching payouts with those, or trading your larger personal capital, you have way better odds of actually succeeding with those things, okay? If you skip this step, it will result in permanent uncertainty, likely what you've been living in up to this point in your trading journey, where you think, am I onto a winning system or am I just getting lucky in the short term? But if you do this step properly, you'll go into live trading with solid proof in your system's performance and your ability to apply it correctly, to produce positive expectancy over time and therefore positive results. And when all of this is done, we can actually start to get interesting. All of that can be done in literally a few months if you actually nail it down and get it done. And when it's done, you can move on to step 4, scaling to 6-figure capital through prop firms. Now, not everyone will want to use prop firms. That's completely okay if you're capitalized yourself. But they are very, very useful. I've had many students succeed with them, and I used them myself when I started trading too. So if you do everything outlined in this series so far, this is where it all gets real. You've got your validated system, your proven positive expectancy, and you have the conviction to execute it correctly based on the backtesting and forward testing that you've done up to this point. Now, one of the biggest problems that traders face when they get to this point in the journey is undercapitalization. See, 80% of traders trade with less than $25,000. Most are trading with $1,000 or less. And realistically, and if we're being honest, I know not a lot of people will want to hear this, but you can't win significantly with these numbers at all. It's not really going to get you anywhere. Prop firms change this, and this is why I like them. Again, if you're against them, if you don't like them, you can do this with personal capital, but this is how you get that big step up towards where you want to be. So basically, a prop firm, if you don't know how they work, is a company that will give you funds to trade with and then pay you out a percentage of the profits. All you have to do is take an evaluation and prove that you can make money without losing money. It's usually make 10% without losing 10%. And if you can do that, they will give you the account. This is just a look into some of the students that have gotten accounts by following the process that I'm laying out for you today. And these are some payouts that one of the members got very recently. And these are some payouts from one of my students very recently from just the past few weeks. That's about $6,500 in just 1 month of trading. So they do work, they are valuable, and they can get you paid. These challenges that a lot of people jump into and lose over and over again are actually not hard if you have a real validated system. So nailing in that dynamic narrative-based strategy and building an approach that works for you, your personality, and your preferences is a very big step in the right direction to passing these prop firm challenges with ease and then actually reaching payouts. And when you do that, you can actually make money in trading instead of lighting it all on fire. So these are the 4 steps that you need to follow in order if you want to become successful in 2026. And you can do all of this before the year is up if you really lock in now. And to show you that this is actually possible, here are just a few of the many funding challenges that people have gotten following the exact same process that I've laid out for you. Here are some of the smaller payouts, but still very respectable, nice payouts that people have gotten trading this system as well. Here's some more payouts. And here is a story from one of my traders who learned from me, who learned this approach to trading, went on to get funded multiple times, make big payouts, and then made $20,000 in a month with this approach. This stuff works. And all of the people you're seeing here followed this process, including these here who literally went full time with trading. These are not exceptions. This is what happens when you stop collecting concept and you start executing an actual real system in the markets, and you follow that 4-step flow that I've laid out for you and build your trading out in a way where everything is consistent, repeatable, predictable, enjoyable, and profitable. The system works, the path is clear, and the only variable as to whether you're going to win or lose now is whether you walk that path or not.
Okay, so I hope you enjoyed that class. Now there are 2 things you can do from here. The first is, this is probably the option you want to go for, I send out daily emails. Now I know that sounds like a lot of emails, but these things are super useful. Okay, this is probably where you're going to learn the most from me without joining my program itself. There is a link to this at the top of the description. You'll get daily emails from myself, various different things. I'm sure you'll find them interesting. If not, you can unsubscribe. And you will also get my best ever free class. Now this goes through how you can break the cycle of win some, lose more, how to win big even with a 40 or 50% win rate, how to lock in a clear, repeatable strategy, pretty much everything that we've gone through in today's class, but in a bit more depth as well. So you'll get that and the daily emails. That's 100% free. And if you want to go a step further and just get into gear learning from me, I also have a program. Now this program is responsible for an ungodly amount of results at this point, to be honest. This is where I actually work with traders day to day and help them out. So all of the information about that is on the second link in the description, which is going to show you what this is all about. There's a lot of information on this page, but you can read through it and see if that's for you. Now, one of those 2 things is going to help you to improve in some way or the other. The only mistake you would make is leaving without doing either. So hopefully I see you on the daily email list, or maybe I even see you inside of the program, whichever one it is. I hope to see you soon.